Most people watching silver right now are focused on the wrong number. They are watching 78 outward I-94 on their screen today, Wednesday, April the 22nd, 2026, and they're trying to decide whether that price goes up or down tomorrow. That is the wrong question. The right question is what 4 separate events are loading simultaneously tonight that will detonate into Thursday's opening session in a way that the silver market has not experienced since January 29th, when silver hit its all-time high of $121.67. Because what is building right now behind the scenes, in the COMEX delivery system, in the Iranian negotiating rooms, in Tesla's earnings call, and in the Federal Reserve's leadership vacuum, is not one catalyst. It is 4 catalysts compressing into a single 18-hour window. And when 4 catalysts hit simultaneously, the price reaction is not additive, it is multiplicative. Let me break down every single one of them with specific data that you can verify, because your Thursday morning is going to be defined by decisions you make or fail to make in the next few hours. Start with the number that should be on every financial screen in America, but is not. The COMEX May silver contract has 241.8 million ounces of open paper interest. The COMEX registered physical vault holds 76.9 million ounces. That is a 3.14 to 1 imbalance. First notice day for May delivery is exactly 7 business days from today. Here's what that means in real terms that matter to you tonight. Every single trader holding a May silver futures contract must make a decision this week. Roll forward to July and walk away from physical delivery, or stand for delivery and request the actual metal. Historically, less than 5% of contract holders stand for delivery. 5% of 241.8 million ounces is 12.09 million ounces. The COMEX can handle that with 76.9 million ounces registered. But what happens if 6% stand for delivery? 7%? 8%? At 6% delivery rate, that is 14.5 million ounces demanded. Still manageable. At 8%, that is 19.3 million ounces. Still within range, but significantly stressful. At 10%, that is 24.2 million ounces. The COMEX starts sweating. But here is what changed this month that makes historical delivery rate comparisons completely irrelevant. In January 2026, during silver's run to $121.67, the delivery rate on the January contract spiked dramatically above historical norms. In 1 week alone, 33.45 million ounces were withdrawn from COMEX registered vaults. That was 26% of the entire registered inventory drained in 7 trading days. The people standing for delivery that month were not retail stackers. They were institutional players who understood that the paper price and the physical price were diverging, and who wanted the metal before the gap became unbridgeable. Those same institutional players are now looking at May contracts, looking at Shanghai physical silver trading at $90.89 this morning versus COMEX paper at $78.94, and doing exactly the same calculation. The $11.95 spread between paper New York silver and physical Shanghai. Silver represents a 15.1% premium. If you can take delivery on the COMEX at $78.94 and sell that metal in Shanghai at $90.89, that is an $11.95 per ounce profit before shipping costs. Shipping a 1,000-ounce silver bar from New York to Shanghai costs approximately $2 to $3 per ounce, including insurance and logistics. The arbitrage profit is still $8 to $9 per ounce, and that profit opportunity is what loads the May delivery mechanism with far more demand than historical rates would suggest. This is catalyst number 1 loading for Thursday, a delivery rate spike that exceeds the COMEX's comfortable management threshold. Now let's load catalyst number 2, because the ceasefire situation tonight is dramatically more dangerous than the headlines suggest, and the specific data from the last 6 hours proves it. Trump extended the ceasefire this morning on Truth Social, crediting Pakistan by name. The mainstream media called that de-escalation. Here's what actually happened. Iran's naval forces conducted 3 separate patrol maneuvers through the Strait of Hormuz between 4 a.m. and 8 a.m. Eastern Time this morning, according to maritime tracking data. Those patrols were not routine. They were deliberate shows of force conducted while ceasefire extension negotiations were still being communicated publicly. Iran is signaling that regardless of what Trump posts on Truth Social, their naval capability in the Strait remains active and operational. Simultaneously, the U.S. naval blockade that Trump confirmed is still in place has now been active for 23 consecutive days. Every day that blockade continues, Iran's foreign exchange reserves shrink by approximately $180 million in lost oil export revenue. Over 23 days, that is $414 billion in lost revenue. Iran's total foreign exchange reserves before the conflict were estimated at $60 billion. They have now burned through approximately 6.9% of their reserves from oil export losses alone, not counting the cost of the military operations themselves. At the current burn rate, Iran's foreign exchange reserves hit a crisis threshold in approximately 290 days. But here is the danger for tonight specifically. Countries facing rapid reserve depletion do not behave rationally. They take escalatory actions to change the negotiating dynamic before their financial position collapses completely. Iran's advisor publicly stated they have new cards on the battlefield that have not been played. Those cards get played when the financial pressure becomes unbearable, and $414 billion in 23 days is significant pressure. What does that mean for silver Thursday morning? If Iran plays one of those unrevealed cards overnight, oil spikes above $100 again. When oil spikes above $100, every mining company on Earth sees its cost structure blow out by 12 to 15% overnight. Silver miners specifically, because silver is capital and energy intensive to extract, face immediate cash flow pressure at $100 oil. Fresnillo, the world's largest primary silver miner, already cut 2026 guidance by 9% before oil hit $100. First Majestic cut guidance 11%. Those guidance cuts happened at $75 to $80 oil. If oil goes back to $100 and holds there, both companies face another round of production cuts, removing additional ounces from already deficit global supply. This is the critical connection that nobody in mainstream financial media is making. Rising oil is not just an inflation story. Rising oil is a silver supply destruction story. Every barrel of oil above $80 removes silver from the production pipeline by making marginal mines uneconomical and forcing major producers to cut output. The same geopolitical event that pressures silver's paper price through dollar strength also destroys silver's physical supply through energy cost inflation. You get hit from both sides simultaneously, and that is exactly the environment that loads Thursday's session with explosive potential in either direction. Now load catalyst number 3. Tonight at 5:30 p.m. Eastern Time, Tesla reports Q1 2026 earnings, and I want to give you specific numbers that nobody in the silver community is tracking. Tesla's gross margin on vehicle sales has been compressing for 6 consecutive quarters. In Q1 2024, Tesla's automotive gross margin was 18.5%. By Q4 2025, it had compressed to approximately 14.2%. Every percentage point of margin compression represents billions in reduced cash flow that could have been deployed into new production capacity, into energy storage expansion, into terafab infrastructure. When cash flow compresses, capital allocation gets prioritized. And the projects that get prioritized are the ones with the highest return on invested capital. For silver investors, the critical question tonight is whether Tesla's energy storage business, which deployed 8.8 gigawatt hours in Q1 versus 14.2 gigawatt hours in Q4, receives increased capital allocation in Q2 guidance, or whether management signals a continued pullback. Here's the specific silver demand arithmetic. The difference between 8.8 gigawatt hours and 14.2 gigawatt hours is 5.4 gigawatt hours of undeployed energy storage at approximately 1.5 tons of silver per gigawatt hour of grid-scale storage. That 5.4 gigawatt hour shortfall represents 8.1 tons of silver demand that did not materialize in Q1. That is 260,000 ounces of silver demand that Tesla's energy division failed to generate relative to Q4 2025. Across the entire EV and grid storage sector globally, similar sequential declines are being observed. The industrial silver demand story is weakening in the short term, even as the structural long-term case strengthens. But here is the wild card that could reverse everything tonight in a single sentence from Elon Musk. The terafab project. Tesla's planned 1 terawatt AI computing facility has been publicly discussed but never formally funded in any earnings call. Tesla's 2026 capital expenditure guidance exceeds $20 billion, but explicitly excludes terafab. If tonight Musk announces a specific capital commitment to terafab, even a preliminary $5 billion allocation, the silver demand implications are staggering. A 1 terawatt computing facility requires silver in power distribution systems, server motherboard contacts, high-frequency signal pathways, and cooling infrastructure. Conservative estimates put silver intensity in large-scale AI data centers at approximately 0.8 to 1.2 tons per megawatt of computing capacity. 1 terawatt is 1 million megawatts. Even at the low end of silver intensity, terafab represents 800,000 to 1.2 million tons of potential silver demand. That number is not a typo. It would represent multiple years of global mine production consumed by a single infrastructure project. Silver prices would never be the same. That announcement, if it comes tonight, is Catalyst 3 loading for Thursday. And Polymarket currently gives Tesla only a 40% chance of beating earnings estimates. But earnings per share is not what matters for silver. Terafab is what matters for silver, and Musk has been known to drop bombshell announcements and earnings calls that no analyst had modeled. Now load catalyst number 4, because this is the one that operates silently but has the most permanent consequences for silver's price trajectory over the next 30 days. Jerome Powell's term as Federal Reserve Chairman expires in May 2026. That is approximately 30 days from today. Kevin Warsh, Trump's nominee to replace Powell, had his Senate confirmation hearing yesterday, Tuesday, April 21st, and it did not go well for the silver market either way. Warsh revealed that he wants to reduce Fed transparency by potentially eliminating post-meeting press conferences. He wants to reduce the number of annual FOMC meetings from 8 to possibly 4 or 6. He refused to provide any details on his new monetary policy framework. And Senator Tom Tillis confirmed he will block Warsh's confirmation until the Department of Justice drops its investigation into Jerome Powell. Here is the specific consequence for silver that nobody is modeling. The FOMC meeting is scheduled for April the 29th and 30th, which is exactly 7 days from today and precisely coincides with the COMEX May 1st notice day window. If Warsh is not confirmed by April 29th, which now appears certain given Tillis's block, Jerome Powell will chair that meeting as a lame duck-fed chair whose term expires within days. A lame duck-fed chair has reduced credibility in markets. Decisions made at that meeting carry an asterisk. Market participants know that whatever policy direction Powell sets on April 29th could be immediately reversed by his replacement within weeks. That uncertainty paralyzes rate-sensitive positioning and creates exactly the kind of volatility environment where COMEX paper price suppression is easiest to execute and hardest to predict. Real interest rates today are 0.2%, Fed rate 3.5%, minus CPI 3.3% equals 0.2%. That is essentially zero real yield on cash. When real yields are zero, the opportunity cost of holding physical silver is nothing. You give up 0.2% in real terms to hold an asset that is up 135.47% year over year. But the Fed is pretending its policy is restrictive when in reality it is accommodative adjusted for inflation. And a leadership vacuum at the Fed in the middle of a war and a COMEX delivery crunch removes the one institutional actor that could credibly intervene to stabilize market expectations. Now let me give you the data that ties all 4 catalysts together into a single coherent picture of what Thursday morning looks like across different scenarios. Silver is at $78, starting at $94 right now on Wednesday, April 22nd, 2026. The overnight low was $75.65 when the ceasefire appeared dead. The overnight high before the Iran news broke was approximately $79.80. The Shanghai physical price is $90.89. The COMEX paper price is $78.94. That $11.95 gap is the single most important number in the silver market tonight. Scenario 1. Tesla beats earnings, Terafab gets announced, Iran holds ceasefire, COMEX delivery rate stays below 6%. Thursday morning, silver opens at $82 to $85. The Terafab announcement drives industrial demand repricing. COMEX suppression fails because institutional buyers step in aggressively. Shanghai premium begins to close from the top as Western prices rise toward physical reality. Scenario 2. Tesla misses earnings, gives weak guidance. Iran holds ceasefire but rejects terms. COMEX delivery rate spikes to 8%. Thursday morning silver opens volatile between $76 and $80. Paper price gets smashed on weak industrial demand signal from Tesla. Physical demand from delivery standees creates a floor at $74 to $76 where strong hands bought last night. The price range widens dramatically as paper and physical pull in opposite directions. Scenario 3. Tesla miss plus Iran. Escalation plus COMEX delivery spike above 10%. Thursday morning, silver flash crashes below $75 on COMEX paper, then immediately recovers as physical buyers absorb everything below $76. This is last night's 90-minute window repeated in daylight hours with higher volume and higher stakes. The recovery would be faster and stronger because institutional players who missed 75.65 last night are sitting with buy orders in that zone right now. Scenario 4. Tesla beats plus Iran escalates. This is the most explosive scenario. Defense silver demand narrative plus AI infrastructure demand plus war premium plus COMEX delivery crunch, all simultaneously. Thursday morning silver gaps up $4 to $6 at the open, triggers short covering, and potentially reaches $85 to $88 before any pullback. This is the scenario that the institutional players positioning ahead of May 1st notice day are hoping for. Here's the data you need to hold in your head as you watch tonight's events unfold. The Silver Institute confirmed 6 consecutive annual supply deficits, 762 million ounces drained from above-ground stockpiles since 2021. 2026 deficit projected at 46.3 million ounces. 15% larger than 2025. COMEX registered inventory down 68% from 240 million ounces in April 2020 to 76.9 million ounces today. China's export license regime restricting silver exports to only 44 authorized companies, active since January 1st, 2026. China's sulfuric acid ban threatening 70% of global silver byproduct supply from copper mining. Chile sulfuric acid prices up 44% in 1 month from Chinese supply disruption. Section 301 investigation targeting Mexican silver imports with public hearing May 5th, just 13 days away. Mexico supplying 25% of global silver production currently under U.S. trade review. None of these structural factors change based on tonight's Tesla call or Iran's midnight decision. They are permanent. They are accelerating. And they are the foundation underneath all the short-term price volatility that makes Wednesday feel like panic and Thursday feel like shock. Here's what I am watching specifically between now and the Thursday open. The Tesla call at 5:30 p.m. for the TerraFab announcement and energy storage Q2 guidance. Iran's official response to Trump's extension between now and midnight. The COMEX overnight session open at 6 p.m. Eastern for evidence of delivery demand building. And the Brent crude price at the London Open around 3 a.m. Eastern, because if Brent opens above $95, the war premium is back, and Thursday morning's silver session will be defined by that number, not by anything Musk said at 5:30 p.m. The Wednesday panic you're feeling right now, looking at $78.94, is not the story. The story is what 4 simultaneous pressure systems are doing to Thursday's silver market while most investors are asleep. The COMEX paper price can be at $78.94 and be completely meaningless as a signal if Shanghai is at $90.89. And the physical delivery mechanism is seizing up 7 business days before first notice day. What is loading for Thursday is not a simple up or down move. It is a structural test of whether the paper silver market can continue to function as a credible price signal when physical reality is $12 higher on the other side of the planet and getting further away every single day.